Okay, so welcome to the Real Estate Investor Goddesses podcast. I'm your host, Monick Halm, and I am here with another incredible real estate investing goddess who's actually she's that and so much more. She's also an expert in asset preservation and 1031 exchanges. So one of the most important considerations for an investor is figuring out how best to structure a deal so that they can keep as much of their money as possible, maybe pay as little taxes as possible, and our guest definitely helps people do that. She is the Vice President and Division Manager for Asset Preservation Inc., Dino Champagne. And before joining Asset Preservation in 2002, she spent 14 years as a commercial real estate broker handling sales and lease negotiations. Prior to that, she was a commercial lending officer at a major bank for 15 years. So she's had a lot of experience. And maybe someday we'll have to get you back in to talk about the brokering and the lending because you know so much about a lot of different things. But her experience has kept her in constant demand by real estate professionals, CPAs, attorneys, escrow officers, financial advisors, and investors. And she has given over 1,000 accredited seminars on IRC 1031 exchanges. And she's a frequent speaker at various real estate and trade associations. And I'm so happy she's here with us. So welcome, Dino.
Well, thank you. I just want you to understand something, though, Monique. I started when I was 2.
Oh, yeah, of course. Yeah, you were just such a precocious child. So you can...
Of course. Yes. You know, Champagne, you have to be.
So, before we get into the 1031 exchanges, I wanted to talk a little bit about your investing yourself. So how did you get started in real estate investing?
Well, I got started in real estate investing prior to have my own home, for example. But beyond that was when a couple of friends and I were having dinner one night, and we decided that it would be fun to get together and pool our money and buy a piece of property, which we ultimately did. After owning that property for a period of time, sold it, and then I exchanged that property into a property that I currently have in Florida, and I bought another piece of investment property. So incrementally, I mean, nothing major, definitely not the large investor of the Trump status, if you will, but you got to start somewhere.
Of course, and that's a perfect way to start, and you're already light years ahead of 95% of anybody else because most people don't have any income producing property. So good for you.
Thank you.
So now let's talk about Asset Preservation Inc. What do you do there at API?
Okay, asset preservation is actually it's a national 1031 qualified intermediary. We facilitate exchanges nationwide. I'm one of the many people within our company that go out and market and teach and educate individuals, investors, attorneys, CPAs, and the like about the 1031 tax code. So to put it bluntly, I'm in the sales arm of it. We have a staff in our national headquarters, which is located up in Northern California. We also have an Eastern regional operations out of New York, and they do all the processing of the files. So I get to bring it in, and they get to do all the hard work.
Okay.
So
that sounds like you're in the more fun part of it.
I mean, everybody has their lane that they ride in, and the people in the headquarters they wouldn't want to do what I do because they don't want to be in traffic 5 hours a day, stuck on the 405 freeway going 4 or 5 miles an hour. So.
Okay, so you're not doing the paperwork, but you definitely know a lot about 1031 exchanges. So for people who aren't familiar with it, what is a 1031 exchange?
A 1031 exchange, I like to use the term, it's the taxpayer reinvestment code, if you will.
Okay.
It gives the taxpayer an opportunity to reinvest into more, to another product that they're selling one and want to buy another investment piece of property. And the beauty of the 1031 is you get to defer the tax. When you're able to defer the tax, that gives you more money to put down on the next property. So it's an excellent way to continue and to grow your real estate portfolio. So this particular code has been in the code section since 1921. A lot of folks think that, like 92, 70, all different years. but in effect, it started in 1921. And with the recent tax reform, we're very fortunate that we're still able to keep the 1031 code, because it was looking like they were going to eliminate us, but they managed to realize that it's a good thing for a lot of folks, not just for investors, but for business owners that operate their businesses out of. So we're still here, so that's why I can have this conversation with you today.
That's great. I had no idea before speaking to you that it had been around so long. I too would have guessed maybe 80s, 90s. And so the tax act that just passed at the end of 2017, it maintained the 1031 exchange. Did it make any changes to the section of the
yeah, there was one change to the section, and that's personal property exchanges. And to clarify what a personal property exchange is, we're talking about equipment, furnishings, fixtures, that type of thing. Sometimes when I say personal property exchanges have been eliminated, everybody's thinking about their primary residence. No, you're good. you're good there.
So real estate is still okay,
Yes, real property is fine. Personal property, like I said, furnishings, fixtures, equipment, also arts and collectibles were part of personal property as well.
Okay. So, all right. So they can't be.
No, it's no longer under the 1031.
Okay. So why is a 1031 exchange useful for an investor?
Well, as I just mentioned, when you're talking about selling an investment property, there's going to be, there's several taxes that are going to come into play. The first tax is going to be the recapture tax for investors that are depreciating their property, whether you do or don't anyway. But for investors, when you depreciate your property, at some point in time when you sell it, you're going to have to pay a recapture tax. That tax is 25%. Then there's the long-term capital gain tax, which is either 15 or 20%, depending on your income bracket. Then there's the net investment income tax, which is it's commonly known as the Obamacare tax, which is an additional 3.8% if your income is at a certain level. And then if you're in a state like California, then there's the state of California tax. So I've just rattled off 4 taxes that are affecting an investor when they sell a property. That means that anywhere between 25 to, I would say, even as high as 40% of your profit is going to be going to the federal and the state taxing authorities, and therefore that's less money for you to reinvest into the next property. That's why a 1031 is good. That's the pro of doing one. Then there's cons of doing the exchange, because there's rules you have to follow and guidelines that you must to comply with in order to earn the tax.
Okay, let's talk about those rules in a second, but I just wanted to make sure. So by doing a 1031, you can basically kick the can down the line in terms of taxes for all of those different types of taxes. You're not paying any capital gains, any depreciation recapture, net investment tax, state taxes. All of those you get to defer until the next sale, or eventually when you stop doing a 1031. Is that correct?
Yeah, that's correct. But one little caveat, you have to look, every state is going to be a little bit different. So you want to check to your state to make sure that it mirrors, if you will, the federal code. Okay. I'm in California. California mirrors the federal code. So you would be deferring California tax. So you could have a little nuance in some other states. You want to check that out. But definitely the big 3.
Great. That's awesome. So so you were talking about some of the rules that govern. I know it's pretty specific. So what are some of the things you can or can't do with the 1031 exchange?
Okay. Well, in order to be able to qualify for a 1031, you're going to have to prior to your closing of your, and so with the qualified intermediary, we actually step in the shoes of the seller, and we become the seller of the property. We're not worried about any of that, so we don't go on title of the property. Prior to that happening, what has to happen is the documents have to be prepared. Once the documents are prepared, they're signed by the client or the taxpayer. When the escrow closes, the taxpayer can't touch their money. So the money is wired directly to us. At that period is when those time frames in the exchange are now going to officially begin. So to complete an exchange, you have 180 calendar days. But within those 180 calendar days, the first 45 days are the identification period. So someone doing an exchange has to identify what they're going to buy within the first 45 days. And those are calendar days. That, I have to say right now, is probably the more difficult aspect of the timeline, because trying to find a suitable replacement property within that 45 days, and identify it makes it really challenging, because you can only purchase what's on that list. Okay. The next rule that you have to comply with, equal to or greater than your net sale price. So, for example, can you hear me?
I lost you for a second. So you were talking about 40 days to identify the property.
45.
And you were 45, and then you said that it's really challenging because, and then it was hard to hear you.
Yeah, it's one of the more difficult parts to the time frame for the exchange, because especially in today's market, because the market is very tight, so the inventory levels are low, and you're trying to find something that is a good investment for you to put your money in to complete the exchange. So that's the hard part right now. So in California, for example, we're seeing folks that are selling in California and buying in other states like Florida or Texas, Arizona, states, where they can find a little more value for their money, and the cash flow is there. So, but the first 45 days is the toughest part of the 180-day identification exchange period. So.
Okay. All right,
okay.
so that's one thing. So the 45 days to 180 days. What's another rule?
The other component to the other component to the rules that you need to comply with is going to be that you have to spend all of your cash, and you have to replace any existing loans that you had on the property. So in effect, you have to buy property equal to or greater than your net sale price. And when I refer to net sale price, I'm referring to paying the commissions for the real estate agent, the closing agent's fees, any title fees, any transfer fees, the qualified intermediaries fees. Those are all acceptable expenses in the transaction. So you can net that amount. And you can do that by buying one property. You can do that by buying multiple properties. Okay. But you have to spend all your money to try to defer 100% of the gain.
So if you have $500,000, you have to get $500,000 worth of property. And just to be clear, it's not just your gain, right? So if you were selling a property and you sold the property for $500,000, but your gain's only $100,000, you actually have to get properties worth $500,000 or more, right? If I understand correctly.
That is correct.
Okay.
Yeah, you understood it correctly, because when you think about an exchange, one of the ways to view it is a continuation of your real estate investment. So when you're continuing your real estate investment, you're continuing with your basis, which you originally paid for the property, and other calculations that come into it, along with your gain. So the basis and the gain both are moving over to the next property. That's one of the cons of having to do an exchange. You have to bring your basis along with your gain, not just the gain.
All right. So I can't just buy $100,000 property to take care of my gain. Everything. Yeah.
Literally, you could. Technically, you'll pay tax.
Right.
So, yeah.
Okay.
Which you didn't invest. Yes.
Good to know.
Yes.
And what are some other things? Because I know that you have to get a quote unquote like kind property.
Okay.
Right? So what does that mean?
Yes. Okay, like kind actually is a very confusing term to some folks, and what it basically means is that you're having to purchase investment real estate. The type of investment real estate, whether it's a single family rental or an apartment building, an industrial building, a shopping center, it makes no difference. So if I'm going from an apartment building to a shopping center, that's like kind property. If I'm going from raw land that I held for investment to 5 single-family rentals, that's like kind. So it's investment real estate for investment real estate. It's not duplex for duplex or apartment building for apartment building. It's very broad in the aspect of the like kind. So
okay, but you can't go from your single-family personal residence to an apartment building, right? It has to be, that would be different if it was owner occupied property that wasn't investment.
Okay, so yeah, owner occupied property, even though we may feel that our properties at our primary residence are considered an investment, for tax purposes they're not. So when you sell your primary residence for, it has nothing to do with the.
Oh,
But
I'm
to
losing. The
flip
sound is getting messed up.
that around a little bit is.
Oh, hold. I'm messing. The sound is getting messed up again. So hold on. Okay, we'll try to edit that out. So let's try that again because it went. The sound got very weird. So can you explain again, like kind, when we're talking about, going from owner occupied, your personal residence, say, to an investment property, or vice versa? Can you use a 1031 exchange to do that?
Okay. And purchase an investment property. There are two different tax codes. So whatever you do when you sell your primary residence, you can do whatever you want. It's not impacted by the 1031. What comes in is somebody might sell their investment property and they want to purchase a property that's going to be their primary residence. Well, that will not work for an exchange because it's a property for tax purposes. So they have to buy an investment property. At some future date, could they potentially convert it? Yes, but that's to be determined by their tax advisor as to, when they can, eventually move into that property. Probably 2-3 years after they've owned it as an investment, would be probably a very safe period. But I'm not giving tax advice.
Okay. All right. So that's good. So that's good to know. You can't go from your personal residence to an investment property or vice versa. But when you're talking about investment property, it's very wide. It can go from land to industrial to commercial to various multifamily house, pretty much anything as long as it's an investment. Sounds like
yes, exactly.
Can be an in-kind exchange. Okay, cool. Now, what about let's see, what else? What other questions that I have? Is there anything else that an investor should think about when they're doing a 1031 exchange that could trip them up? Is there any other rules or regulations that are of importance?
Well, yeah, the rules are, the hard part to the rules, like I said earlier, was the 45 days. Another thing that could potentially they have to be careful of is that when somebody's doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. So they can't go out and pool money with their friends, create a partnership, sell as an individual, buy as a partnership. That's not going to work for the exchange. So you want to be very careful that when you're dealing in the exchange arena, that you're complying with the rules that are put out there. Same taxpayer selling must be the same taxpayer purchasing. I think the things to be really aware of when you're starting to consider selling an investment property, because that's when a 1031 is going to come into play. So you already own investment property. Now you're going to sell that property. So when you're thinking about selling that property, you want to first, a couple of things. One, find out what's going to be your tax situation when you sell this property. You should always consult your tax advisor to make sure that doing an exchange is something that you need to do, that you're going to benefit from. Then if you find out you're going to have a very heavy tax load that you don't want to spend, $100,000 or $50,000 for that matter in taxes, it's important then to get yourself educated on the 1031 process so you know how it's going to flow going forward. Because certain things in a 1031 are not fixable if you do them wrong. Okay, right. So you want to make sure. The next important thing I believe for investors is start looking out there. Where are you going to want to reinvest? Okay, what are you going to be looking at? What's your strategy for reinvestment? Is your strategy for reinvestment for you to, if depending on your age, to continue to build wealth? Then, so if you're a younger investor and you're not looking for cash flow, then realistically what you're going to be dealing with is you're looking for appreciation. So you're going to go into markets that maybe the cash flow is not all that great, but you're looking for the appreciation to make up the difference. If you're older, you're going to be probably looking more toward what's my cash flow, because you're going to look for the cash flow to subsidize your living when you retire.
Right.
So, yeah, so you want to look at all these things. What's your goal as an investor? And have, maybe have a mentor, have somebody that's going to be helping you to understand what your goals are, and be realistic. Be realistic. And one of the things I can say is, don't just buy a piece of property not to pay the taxes, because sometimes you can buy something to avoid the taxes, but you bought a bad piece of property and you're now potentially in a worse position than you would have been had you paid the taxes.
Right.
So just careful.
You bought yourself a problem. So.
Yes.
And I wanted to ask you about one thing, because this is something that we have done. So I'm a syndicator. We bring groups of investors together, and a couple of times we've had folks that wanted to invest using 1031 money. And one of the, you were saying it has to be the same ownership that sold, that's using the 1031. And we were able to get that 1031 investor in by doing a tenant in common situation. So can you talk a little bit about that, or what?
Sure.
That's okay.
Right. Yeah. So what you're doing in a tenant in common, each owner that's on there. So say you did a syndication, and I'm going to make a leap. It's a partnership that it's taxed as a partnership. Would that be fair? Your syndication?
Yes. Mm-hmm.
Okay.
Well, it's an LLC.
So your LLC taxed as a partnership because there's multiple members, right? Mm-hmm. So you've got your LLC that's on title, and then all of a sudden, let's just say I'm coming in with my 1031 money. Well, if we create a tenant in common agreement where I'm coming in and buying an undivided fractional interest, then I own that particular portion of the real property. I don't own a share in your LLC. That's why you're able to do that. At some point, I can turn around when the project gets sold, I can sell and I can go my separate ways. That's why you used to see back in 2002, there was a revenue procedure that came out about tenant in common, and a lot of folks were going into the tenant in common product. And that way they were putting their money into a larger piece of property, but when that property sold, they can go their separate ways, and it worked for an exchange. So that's one way to carve out what your situation with an exchange buyer, because they were not going into the partnership interest, they were buying into the real property itself, the fee.
Yeah.
That's why it worked.
Yeah.
So
that there are ways to get creative with this. It just has to make sense for everyone.
Mm-hmm.
So what are some of the mistakes that you see people making with 1031 exchanges?
The mistakes that I see people making is the fact that they're not paying attention to the timelines, because the timelines go by very fast and they're not forgiving. Okay, yeah. So if you're not responsive to how fast you have to move, you can end up running out of time, and now you're throwing on ads on the identification form, and maybe none of those addresses you're going to buy. So not paying attention to the time frame, not preparing themselves in advance. So in other words, when they're getting ready to sell their property, they're hemming and hawing as to whether I'm going to do an exchange, not do an exchange. And therefore, they're waiting to the last minute, and the escrow is going to close, the closing of the sale is going to take place, and they say, well, I'm setting up the exchange now. To me, that's clear that you have not been looking for anything, scrambling to try to find something in a low inventory market. So, those are one of the issues, that I see, where folks are not planning far enough in advance. And if one of the things that's important for an investor, if you're not sure whether you're going to buy something in an exchange or not, but you want the opportunity, set up the exchange. It's not that expensive to give yourself a 45-day free look period. Okay, set it up, then try to, because if you close on the property and then subsequently you find something you want to buy, it's too late.
Too late.
So set up the exchange. You'll be, I like to use the term, your money's in lockdown for 45 days, but at least you have that opportunity. That's the window of opportunity. So you're going to pay a fee for that, but it's nominal to at least have the opportunity.
Okay.
So those are some of the mistakes that we see. And
you guys
it's mainly
heard that.
not.
Yeah.
Yeah.
You have to have the 1031 exchange before you close on the sale of your property. You have to have it set up or else you lose it. You have to have the
Yeah.
properties identified within 45 days or you lose it. And you have to complete the sale within 180 days or you lose it. And you end up having to pay the taxes. So pay attention to those timelines in order to be able to take advantage. And I
Right.
did
Very
like
well said.
and I liked your advice too about making sure that it makes sense. So you want to find out how much you would have to pay before you decide if you want to jump through those hoops.
Well, because there's a lot of, when we're dealing with investment properties, there's passive losses. And depending on what individuals' income levels are, they may not be able to write off some of those losses the year that they're dealing with it. So they sort of sit in reserve. So you always want to consult your advisor because maybe you have enough passive losses to offset something. That's why it's so important to, and the one thing, another one, big mistake, making sure you have a tax advisor that understands real property and 1031s, because they're the ones that are going to guide you through the aspects of the tax code that need interpretation. The 4,580 days needs no interpretation. That's pretty clear. But other aspects of it is, how long am I supposed to hold the property for it to be declared held for investment? When can I move into that property that I'm acquiring? Those are all discussions to be had between the taxpayer and their tax advisor. Because like I say, you will never see me at the audit. So, because I don't give tax or legal advice.
All right. That's really helpful. I want to ask you a question about your own investment. So we're going to switch
Sure.
gears for now.
Mm-hmm.
Anybody who has been an investor for any length of time has probably made a mistake at some point. And I think that we learn a lot more from our mistakes than we do from smooth sailing. So as an investor, what was your biggest mistake and what have you learned from it?
Well, my biggest mistake, I would say, is buying property sight unseen. Really good deal. Bought the property, and it ended up being, I had to put a lot of capital improvements in it because what they might have viewed was okay, I did not. So never buy a property, in my opinion, sight unseen. The next thing I think, the next mistake that you can make easily is when you're buying into an investment property, homeowners associations, are good for some things with a property. If you're buying into a homeowners association, a property that has a homeowners association, vet out the homeowners association's financials, that sort of thing. Who is the management association? So those are some issues. One of the things that I like to say is be realistic about what the rental market is going to do where you're going. So you have to do your homework. Due
diligence.
Have reserves. Yes, you have to do some, and have reserves. You're going to need reserves. A statement I like to make is, while you may not receive any surprise income, you are bound to find some surprise expenses, because property, like it's, they own it themselves. Those are the mistakes is, never not seeing the property before. And then I would say one more mistake. I'm not sure I would say it was a mistake, but I would say when you're in a high valued area where appreciation, like in California, and you're going to other areas, do not expect the same appreciation rate, in those areas that you're going to get. It's going to be a slow crawl up, as opposed to, maybe Northern California and Southern California, where it moves pretty quickly.
You might be able to get more cash flow and get more for your money, but not expect
but not the appreciation. So if you're 60 and you want the cash flow, that's probably fine, because you're not you're not worried about the appreciation as much. But if you're younger and you want the appreciation, you gotta know what your goals are, and also know what your exit strategy. How long you're going to stay in it? Are you staying in it for 3 years, 5 years? So don't forget about the exit strategy.
Such good advice. Um, and maybe you've already answered it, but what do you wish you'd known at the beginning that you now know?
Wish that I now know to do a little more vetting on the on homeowners associations. Go look at the property. So yeah, those two things. Yeah, I'll never buy another property again without going visit it. Okay, to
Yeah.
check it out. So yeah, and I think once you buy a property, especially if you're buying something out of state, because mine are out of state. If obviously I'm saying go and visit it, it's not like it's down the street. Go visit your properties. So check it out, and then check out your management companies too, because they're going to be the lifeblood of the health of your property. So so
Yeah.
vet the management companies out as well.
They will make or break your deal for sure.
Exactly.
Um, so for people who want to reach you and find out and get in contact with you about 1031 exchanges or anything else, what's the best way for people to reach you and find out more about what you do?
Sure. My office number is 866-857. Hold on, 1031. So they can call my office number 866-857-1031, or they can email me at Dino, Dino, at apiexchange.com.
Okay. So you guys heard that. So lastly, we're gonna conclude with the Trinity, as we do every time. A Trinity is a brag, a gratitude, and a desire. So what is one thing you're celebrating right now? What's your brag?
Gosh, I'm trying to think, what would I be bragging about right now? I'm above ground.
That's always good to brag. I woke up today, I'm breathing.
Each day is a new opportunity, right?
Yeah.
So I'm still alive. I'm bragging that I'm still alive. And I've got great friends, and I've got, loving kids and grandkids. So that's my brag. And a loving family.
Well bragged. And what's one thing you're grateful for?
I'm grateful for, I think what I'm grateful for is the understanding that they're sometimes disguised in challenges or opportunities. So I'm grateful to constantly, that I can remember to remind myself that when you're in a situation where things don't seem to be flowing as smoothly down the river as you'd like it to be, that I'm grateful that I can turn around and go, okay, it's all going to be okay. So I'm grateful that I can refocus. Sometimes that refocusing happens, 3 times in 5 seconds, but nonetheless, I'm grateful to remember that I can do that. So.
Beautiful. And lastly, what's one thing you desire?
One thing I desire, universal peace. I desire, what I would like to desire is probably more balance in my life. Okay, I work a lot, so finding some time to have some play time. I was teasing with a friend of mine the other day. I said I have 6 weeks of held over vacation. So yeah, it's a lot. So you got to find some times for me to get out and go do certain things. So I think finding the balance is what I desire. So.
Okay. So shall your desire be, or so much better than you can imagine.
Thank you. I love it.
All right. Well, thank you. I'm so appreciative of all this incredible information you gave us. Y'all, to reach out to Dino, you can email her, Dino at apiexchange.com or 866-857-1031. It's very easy to remember. You can get in touch with me at realestateinvestorgoddesses.com and join our private community on there and get the free ebook and lots of other goodies. Thanks again for everything, and we will see you next time. Bye-bye.